Dividend stocks, bonds, and options, three powerful ways to earn income in the markets. But which one is right for you? Each has its own unique style. Dividend stocks reward you with a share of profits, bonds pay you fixed interest like rent, and options give you the flexibility to earn through smart strategies. In today's video, I'm going to explain each one in detail, compare their strengths and weaknesses, and help you understand how they fit together in a portfolio. By the end, you'll know exactly which income style matches your goals. I'm the option guy, and this is going to be fun, colorful, and packed with knowledge. Let's dive in. Let's start with dividend stocks. When you buy a dividend stock, you're buying a piece of a company. Some companies, especially large and stable ones, share a portion of their profits with shareholders in the form of dividends. Think of it like a fruit tree. The tree itself is your stock. It grows, it has value. But every season it produces fruit and you get to eat that fruit. That's the dividend. For example, if you buy shares of Coca-Cola, they might pay you a dividend every quarter. So while you still own your shares, you're receiving income regularly. Dividend stocks give you the best of both worlds. Income from dividends and potential growth if the stock price goes up. But remember, dividends are not guaranteed. A company can cut or stop them during tough times. Now let's look at bonds. Bonds are different from stocks. When you buy a bond, you're not an owner, you're a lender. You're loaning money to a government or a company, and in return they agree to pay you interest called the coupon at fixed intervals. Then, when the bond matures, they give you back your original investment called the principal. Think of it like being a landlord. You loan your house to a tenant and in return you get rent every month. The house still belongs to you, but the rent keeps coming in steadily. For example, if you buy a $1,000 U.S. Treasury bond with a 5% coupon and 10-year maturity, you'll receive $50 every year for 10 years. At the end, you'll also get your $1,000 back. Bonds are considered safer than stocks, especially government bonds. But safety usually comes with lower returns. And then we have options. Options are contracts that give you the right, but not the obligation, to buy or sell a stock at a specific price before a specific date. Now, options can be used for speculation, but they can also be used for income generation, which is what we're focusing on here. The two most popular income strategies are selling covered calls and selling cash-secured puts. With a covered call, you already own shares, and you sell someone else the right to buy them from you at a higher price. In exchange, you collect a premium like rent but from the stock market. With a cash-secured put, you promise to buy shares at a certain price if they fall, and you get paid a premium for making that promise. Think of options like juggling coins at a carnival. It looks exciting, it takes some practice, but once you get good at it, you can collect coins regularly. Options give you flexibility and higher potential income, but they also carry higher risks if you don't manage them properly. Now let's compare these three income styles. Dividend stocks are like owning a fruit tree. The tree grows and every season it gives you fruit. You can eat the fruit or reinvest it to grow more trees. Bonds are like renting out a house. You don't own the tenant's life, but you get regular rent payments. Stable and predictable. Options are like juggling coins at a carnival. Done well, you can collect lots of coins quickly. But you need skill and discipline or you might drop one. Each of these methods pays you differently, but they all generate income in their own way. Here's where things get interesting. Risk versus reward. Bonds are the safest. You know exactly what you'll get, unless the issuer defaults. But because they're safe, the returns are usually lower. Dividend stocks are in the middle. They can provide steady income and also grow in value. But dividends aren't guaranteed, and stock prices can go down. Options can provide the highest income potential, but they require skill, experience, and discipline. Done right, they're powerful. Done wrong, they're risky. It's like riding different roller coasters. Bonds are the kiddie train, dividend stocks are the medium ride, and options are the big looping coaster. Each has its own thrill level. So, which is best for you? The answer depends on your goals. If you want safety and predictability, bonds are a great choice. If you want a balance of growth and income, dividend stocks work well. If you want flexibility and higher income potential, options are the tool for you. But here's the truth. Most smart investors don't pick just one. They combine all three. Bonds for stability, dividend stocks for long-term growth plus income, and options for extra cash flow. That's how you build a well-rounded portfolio. Now you know the differences between dividend stocks, bonds, and options. Each one has its own role in generating income. The safest path? Use them together to diversify your portfolio and balance risk with reward. If this video helped you, make sure to hit that like button, subscribe to the Option Guy, and turn on notifications so you never miss another detailed explainer. Thanks for watching, and I'll see you in the next video.